So my view is they will use the stronger dollar as a carrot and a stick. I still think by the end of this, inflation will undershoot, not overshoot, because of the weird dynamic that caused by the pandemic. If it goes wrong, you don't lose a lot. So that's the other way of looking at it. I get it. If you're professional, you might look at your Euribor SOFR spread, stuff like that, stuff to be done. If you're not, but you want to bet on this.
Raoul Pal reveals how the strong dollar, inflation fears, and global liquidity crises are creating ripple effects in the markets. Could central banks lose control? And what does this mean for Bitcoin's next big move? With explosive insights and bold predictions, Raoul breaks it all down. Stay tuned to uncover the key signals you need to watch now.
Less serious note, we're all saved because Jim Cramer came out this morning and said stocks look awful. So I'm like, that probably means they're going to end up in the green today. So we're all probably saved. The dollar is driven by fears over the new Trump administration and what tariffs mean. And that has pushed the dollar higher and rates higher. And this whole thing is the exact same setup. And you and I have talked about this, of the dollar and rates in 2016-17. With the same set of Trump outcomes and tariffs and the same policies, it did the same thing. The first thing Trump did when he got into office was say, I want a weaker dollar. And he's already said rates are too high. So they're not stupid. They also know that they've got debt to roll, that they also have trade negotiations to do. So my view is they will use the stronger dollar as a carrot and a stick, which is China, you're going to have to devalue your currency unless you play ball with us. But if you do play ball with us, we will inject liquidity into the dollar system. We will lower the dollar. We will jawbone it lower. And you can then stimulate your economy, because the Chinese cannot stimulate right now without risking a breaking of the yuan peg, which they don't want. So I think it's all part of the Trump trade negotiations. And we know that the teams have already been kind of speaking to the Chinese and the Europeans and everybody else. When you go back to Besant, who I know decently well, Scott has made it clear that the dollar is too strong and that he would want a weaker dollar. You know, lower oil, weaker dollar. They want easy financial conditions because they want to win the midterm. And that's a big thing. At some point, we're going to need a Plaza Accord if this continues, but we are going to have to get the dollar lower. Now, I don't think the Plaza Accord idea is this time around. I think it's probably closer to 2030 that people are just going to go, we can't deal with this dollar. Now, the dollar is structurally strong because the world is 50% in debt in dollars and there's a shortage of dollars. The moment the US takes liquidity out of the system, it's a game of musical chairs and it drives the dollar higher. So, you know, people will bid up for dollars. So that's where we are. We've also, as you talk about a lot, we are waiting for the injection of liquidity that comes as the reverse repo redrains back to zero, then probably the end of QT, and then the draining of the TGA. Also in the Fed minutes, the previous minutes, they had talked about that they're not keen to rebuild the TGA immediately afterwards and have a tightening of financial conditions. So what does that mean? I mean, either there's another way around it, or as you possibly suggested, it could mean QE, which sounds ridiculous now, but who knows? The other thing that this financial conditions is doing is pushing down forward growth expectations. And so it starts to make you think Q1, Q2 might be weaker, and that gives the Fed more cover also to cut rates. So lots in that. Okay, so this is from the January GMI. This chart at the top is global M2 last time around versus this time around. And global M2 last time around, this time around, it's identical, which is kind of weird. Then we also have beneath it is the chart of the NASDAQ, and that's pretty much identical. So we have a repeat in the monetary conditions, global M2, because the dollar was strong, that's what's pulling back global M2. It also caused markets to readjust. When we look at Bitcoin, we can see the phasing's out, but when you kind of match up the phasing, what happened, it was the 4th of Jan, we had a correction like we're having now, and then Bitcoin went up. And once you match the two, you kind of get a very similar pattern. So what we've got is, and also here's the economic surprises index and the DXY. It's been coming lower. It should drag the DXY, change rate expectations. Fed cut may change because there's now like 25 basis points priced in. Okay, as a risk reward, there's a decent chance we get something. So it's like all the factors are in play, and whether the market sniffs it out or not, I mean, we've got another week until whether we get fuller announcements beforehand or we have to wait for the inauguration and stuff. I don't know. But my base case is that using the historical parallel, I think we probably put the low in. I mean, Bitcoin's price action was ugly today. Let's wait and see. Not that I'm not buying, not selling, not doing anything, but it's either your outcome, which is a sharper fall for longer, in which case it's fully mirroring the M2 drop, or it does what it did last time, which is it prices in the first part of the M2 drop and then dislocates, and it tends to dislocate the rest of the year because there's more speculative flows in the final year. Liquidity should come in. So that's my view.
Raoul Pal dives into how the strong dollar is shaking global trade and financial markets. He discusses parallels to 2016 to 2017 under Trump's policies, and how the current administration may use the dollar as a tool in trade negotiations. Raoul explains why the U.S. might be forced to weaken the dollar to manage debt rollovers and stimulate liquidity, all while central banks globally face pressure to act. Switching gears, Raoul outlines Bitcoin's technical outlook, pointing out that its price action mirrors past cycles. He believes the recent correction could signal a bottom, setting the stage for a rally as liquidity improves. He also warns about the risks tied to rising inflation expectations and how they could complicate central bank strategies. Stick around as Raoul uncovers actionable strategies, including the surprising role crypto might play in navigating these turbulent times.
It is and isn't. The one thing I am looking at is it has been the canary in the coal mine for the bond market. The UK seems to have the worst liquidity of all of the major bond markets. And if I look at on Bloomberg, the gilt liquidity index, it is now continually trading higher than the Liz Truss, gilt intervention. So it cannot be escaping the central banks that inflation expectations are stable and yet yields are exploding higher. And again, right in your wheelhouse, it is telling you, screaming at you, there is not enough liquidity. Now, and understand they're scared because they've just gone through that inflation episode and everybody's still angry about it and whatever. So they're reticent to do something. So they're trying to hold on as long as possible before injecting liquidity. But politics will trump all, and US politics is the big daddy of it all. And the US needs to add liquidity because they're about to have the debt ceiling shut down, and Trump has got to show markets going up, people are happy, all of that. And we know how to do that. It's simple. Just jam the pedal on the accelerator with liquidity and everybody's a winner. I don't think liquidity affects inflation, really. I think they're driven by different things. One is debasement, one is the price of goods and services, and I don't think they're necessarily driven by the same thing. A lot of this is also the year-on-year base effect. So, and the central banks know that as well, which is why they've been saying, the Europeans, the US, everybody's kind of like, it's going to be a bit wiggly for a while. But overall, we still haven't fully deflated all the housing stuff that's back-end loaded in CPI. So it's going to be heavier than people expect. Also, we're expecting to see economic growth slow down somewhat. The SESI kind of says we're going to get weaker data, but anything now, like the high yields now, plays into inflation in 6 months' time, 12 months' time, i.e. lower. So the answer to inflation is having bond yields what they're doing. I still think by the end of this, inflation will undershoot, not overshoot, because of the weird dynamics that caused by the pandemic and this lagging of housing and rates being so high for so long. It doesn't affect Microsoft and Apple and Google or whatever, but it sure as hell affects anybody on a variable rate mortgage or anybody who's borrowing money elsewhere in the economy. But it takes time. DEC 2025 SOFR futures, something in the short end of the curve that you won't get killed on, but becomes slightly asymmetric, or even options there. That's probably in global macro land, not a bad bet. I think trying to find a topping pattern on the dollar is hard, but when it happens, I think you can press it because it'll probably evaporate fast. And the other easy bet is crypto is the ultimate liquidity instrument. So you should be looking at the dip. And I think we put the low in today, but maybe I'm wrong. But either way, if you're looking for some way to express that the market's different, because don't forget, if there is a slowdown, well, crypto will do well because of liquidity. The markets have already sideways traded for a while now. And I hear you, but they're very difficult strategies to put on for normal people.
Yes.
The easiest way to, I haven't looked at the cost of options, but some of the best trades I've ever done in my entire career have just been buying call spreads on, like DEC 25 SOFR call spreads. I don't know what they're priced at, but you probably make a good 5 times your money on a bet like that. And if it goes wrong, you don't lose a lot. So that's the other way of looking at it. I get it. If you're professional, you might look at your Euribor SOFR spread, stuff like that, stuff to be done. If you're not, but you want to bet on this, feels that just, 25 basis points. Yes, we do. I think everybody does. The Chinese, the Japanese, the Europeans, the Australians, the UK. I mean, everybody wants a weaker dollar. One thing I do know is Januaries have this lovely habit of blowing everybody up before the true trend establishes. In GMI, I've been writing for 20 years, I've never made a trade in January because January always gives a conflicting signal. And so the signal now is, oh my God, the market rates, this is terrible. And usually what happens is it completely reverses sometime in Jan or Feb, and the market then sets its direction. So I never read into Januaries.
Raoul Pal's insights paint a vivid picture of markets on the edge. From the strong dollar's global impact to Bitcoin's potential breakout, this is a moment of massive opportunity. Whether you're trading crypto or monitoring inflation trends, understanding these shifts could be your game changer. Subscribe now to stay ahead with expert market analysis and discover how Bitcoin and macroeconomics collide to shape the future. Until next time.